All right, we're finally live. All right, so I'm Ed Parcaut, one of the hosts here, and we have Bobby Atkins, who's doing the other side. Atkins, I gotta say, what is today?
Atkins.
What did I do today? I need to go back to bed.
Today's Tuesday.
Well, no, this is the problem when you actually work out at 5 a.m. in the morning, get up early to work out. You're like dragging the rest of the day. Things just don't work out. But today's live, what we're talking about today is home loans 101.3 FICO score. So what we're going to get into, and I'm going to flip this over to Bobby, and he's going to ask the questions. But basically, a couple of the main topics today about FICO score is, how do you know what your FICO score is? Why could it be different than what you see on other applications or other apps out there or from your credit companies? And then the other thing would be how to make it better. All right. Those are three things we're going to talk about today. All right. So I'm going to move you over and you take over. All right. Ask the questions because I know the answers and I don't always know the questions.
Yeah. And I know some of these answers, but I want to ask them from a perspective of a, first-time buyer.
Okay.
Especially someone who hasn't had a lot of lines of credit, maybe only purchased one vehicle. A lot of times they'll just kind of rush you through that process. They won't explain what they're looking at. They'll just tell you, yeah, you're approved, you're not approved, whatever. So what is a FICO score? Just the basics of a FICO.
So basically there's three bureaus. They all have their own different scoring system, and that they call either a FICO or a Beacon, and I forget the other one. But basically, we generically call it FICO across all three. And basically, it's a score that they come up with. So, and that tells you what you can qualify, and we use that for qualification purposes. Now, I want to explain that when lenders run these scores, we're using an algorithm that they have come up with to come with the scores that we, with the algorithm that we use. And I'm going to quickly get into the other part that I talked about. Why could it be different? So when we run somebody's credit, we could show a different scores, of the three scores than what you see on your credit card company that says this is what your score is, or Experian Direct or TransUnion. And if you read their fine print, they say or Credit Karma, they say we use a different algorithm than what a lender would normally use. And a lot of people say, then why would I pay for this service? Why do I want to watch it? Well, it's important to know what your numbers are, so you can work on them, even though you don't know what our number is. I mean, 9 times out of 10, it's really close. But sometimes I've had it where people have said, well, I had a 720 and you ran my credit and you said my middle score is 680. Well, they're looking off of one score and we're looking off of three scores, right? So we look at all three. And if one, all right, and how this comes up is, say I run your credit, you have a 690, a 720, and a 580. Right. We take the middle of those three. So the 690?
690. Yeah.
Yeah. So that we would use that score. We don't use the bottom. We don't use the top. We use the one that's right in the middle. And like we were talking about before we came on, you were like, you average it, right? No, they came out with where you can average it, but doesn't mean that that's a better thing. I prefer to use the one that's there, because if I average with the scores I just told you, your score wouldn't be the 690 I talked about. Your score would be like 660. So you don't necessarily want them to average it.
But now FICO is not the same as your credit score, right? So it sounds like FICO is more of like a risk assessment of your ability to pay back money.
That's exactly what your score. That's exactly what your score. That's the risk. That's exactly what a FICO score is, or a Beacon score. And the numbers we use, that's an algorithm to figure out how risky you're going to be for that loan. Somebody who has a 640 FICO score versus somebody who has a 740 FICO score is 17 times more likely to go in foreclosure.
Wow, I didn't know that statistic.
Yeah, so that's the reason they use this numbers. They really pushed it back late 90s into 2000. They went from a system that it was there where now it was more risk-based more than anything else with the FICO scores. And so conventional Fannie and Freddie, they're huge on what the score is, and then they look at what your LTV is, they look at the rest of it, and that's how they come up with your actual interest rate. Where FHA and VA kind of does the same thing, but it's not so risk heavy on, meaning the difference between a 680 and a 720 on those is not that big of a deal in the rate. But the difference between a 680 and a 620 is a difference in the rate, where on conventional, you couldn't even do it. Are you following me?
Yeah. Yeah. And what is the highest FICO score someone can get?
They say 910. The highest I've seen is 890.
Yeah. Okay.
Yeah. So, but anything over 760 doesn't matter. It's like
Okay.
magna cum laude. It doesn't matter anymore if you got two, But 760 and a loan amount of 400,000 is the sweet spot for the best rate. So
Gotcha.
the higher the loan amount, right, at 760 from 400 or above will get you the best rate. And then add the LTV, right? Then you add, if it's at a 50% LTV or a 65, a 75, 80, then that changes the rate. And that's how that could be a whole different class on rate. How do we figure out rate?
And for the people who haven't seen the other videos, LTV is loan to value.
Correct. Thank you for
Yeah.
explaining that.
No, that's all right. I know sometimes we can get in the weeds there.
Well, yeah, I'm just explaining. I don't know, just tell me to explain whatever I say.
No. We're trying to bring it down. What is the easiest way for people to fix it? So say someone comes to you with a 620 FICO score and they need to bring it up. What ways would you recommend if they don't I know you've talked before about having secured credit cards.
Right.
You
We'll go
mentioned
through all that.
a new program. Yeah. So if you want to talk about that.
Yeah. So basically, no matter what your score is, if you're a 710 or a 700 or a 620 or a 580, we always look at what we can do to make your score better. And the reason is the higher the credit score is the king when it comes to, especially since the pandemic, what you want to do, how much money, what's your rate's going to be, how much it's going to cost you for that rate, what you can do or can't do is all based off of the FICO score, or we'll just say the score, your actual credit scores that you get, right? They're all risk-based. So what we do is we look at and we do these things called what if. A lot of people every company has this technology, but not everybody does this, right? So we look at each one and say, and it'll tell us, all right, if you're at 620, you want to get them to a 660, and then you run that scenario and it tells us what they need to do. And as long as they do what it tells us, and they don't add any additional debt or don't have any additional things change from what the credit report is, then it will actually do that. So a lot of times we look at it, it's saying to pay down, you have $5,000 on one, you have one credit card that has a limit of 5,000 and you're at 5,010. First thing is going to tell you is lower that down. The question is, they don't tell you, it'll be how much lower do we need to get that in order for your score to go up? And that's what that software will tell us. And it will tell us, and if we have had people who come to us with no scores at all. And then what we tell them to do, what you were talking about, is the secure credit cards. Go get 2 or 3 secure credit cards. We can tell them the different companies. We don't recommend that you have to go to the company. These are just companies. And I'm going to tell you, the reason I offer the companies that I tell them to go through is because I use them. After 2006, I got hit really hard with my industry, what changed and I had some stuff on my credit that affected my credit score. I did the same thing that I'm telling people to do, and it works because I did it. Okay. I'm not just telling you. When people come to me, there's no judgment zone. Cause if you're telling me something, it's probably happened to me already. I've been divorced twice. I've had, everything that could happen to me in my life probably is nothing that can, so just come to me. Don't worry about being judged. We're not here. We're here to fix things. If we run your credit and you can't buy today, we'll help you figure out when you can buy and how long it's going to take for you to be ready to buy. Right.
Exactly. And that's the encouraging thing, because a lot of folks, they think, well, it's kind of a hopeless situation and I'll just give up on it. I'll just be a renter the rest of my life. But, obviously you can make a plan for them to have that, destination. Even you said like before, like a year, even if it's like a year out.
Right. I had one person 1 year. Normally it's 6. I mean, if you have no scores in 45, 60 days, we can get you scores what are probably close to 700 just because you have no bad debt. When you have bad debt, bad things on there, when I mean bad debt, like late payments, but the things are paid off and closed, if you have no good debt on there, all you have is bad debt. So you need to have, and so you'll have no FICO score. So you need to get some good, it's just like a GPA, right? If you got all Fs, it's really hard to get to that A, right? Yeah. Going forward to get that great GPA that you want, that's the 4.0 or whatever, it's really hard to get back there. Same thing. So if you don't have those mistakes, it's so much easier to get to that 4.0. Are you following me here? Is this easier to explain?
Yeah.
All right. I mean, if it's not, come up with a different way to explain it. Basically, I prefer, if you don't have anything, call me. We'll fix it. We'll get you there real quick. However, if you have old debt, then you still need to do the exact same thing. You still get secure credit cards, And then the other thing that we have done lately is we came across a company that will put your rental history on your actual credit report. And that usually jumps at about 40 points.
That's huge.
Yeah, it's big.
Well, and now one question I get a lot, and I haven't been able to answer it, so I'd ask you right now, is what about student loans? So as far as lenders go, does FICO take into account deferred student loans, or if they're not deferred but they have late payments? Because I know some creditors count that, some don't.
No, everybody counts student loans. Whether if they're deferred, we have to take a percentage of whatever your balance is, or you have to provide a document that says your minimum payment is this. Even though because it used to be if they were deferred for a year, we wouldn't have to include it in your debt to income ratio. That changed a couple of years ago. So now we still have to. Fannie Mae is one. Bear with me here. Things have changes all the time. Last I heard, Fannie Mae was 1% of the balance. Freddie Mac is 0.5% of the balance. So if you have a $10,000 balance, that means 1%, your monthly payment would be $100 is what we'd hit you for. Freddie Mac is $50. FHA is $50. So each one of those has their own percentage that we have to use if you don't have a payment on there, or if it's deferred. So everybody still has to hit you with it. The issue, other question you asked is, what if you have late payments on your student loans? Well, it's just like a late payment anywhere else. It's going to be held against your FICO score. That's built into the algorithm. That has nothing because that's about late payments. Now, a recent late payment of even $15 can drop your score by 80 points. Ooh. So and people go, well, it was only a $15 late. It doesn't matter. Whether it's $15 or $10,000 payment, it's still going to affect your FICO score as a late payment, and it's still going to affect you. New recent late payments are huge. The other thing we tell people is never get rid of your credit cards. Keep paying on, just put a little bit on it here and there, and keep them, because if you cancel your credit cards, you will lose all the history that you've acquired with that card. And credit cards are the way to build history, because you have installment loans, you get some credit from that on your numbers towards your FICO score or Beacon, whatever. You'll just say your credit scores. But credit cards, how you use them, utilization of them, how much your balance is versus your limit on there. If you're at a 50% or a 70% limit on there, or 100%, that affects your score greatly differently too. So they prefer a 30%. We used to say 50%. Now we see it's at 30%, and then you want a better score, you get it down to 10%. For a lot of people, it's really hard to do that and still use their credit cards. So I tell people, if you're doing this to fix your score, and you go get a $500 secure credit card, and what a secure credit card means is you give the bank that's going to issue you a credit card $500. They hold that money, issue you a card, you use the card, put $20 on it. I would say for gas, but you can't do anything today for $20 on gas. Buy a coffee, buy whatever, and pay it off. Don't use it more than that. Just put one thing on it and pay it off a month. And because if you max it, you're going to get negative credit. You're not going to get positive credit. So it's important that you utilize it. And that's why it's really important. I know there's some gurus out there who say, cut up all your credit cards, pay them off, cut them up. You do that, you're going to go from having a score to having no score, because you're going to lose all that credit. A friend of mine, she came to me for a refinance. She had a 780 FICO score, canceled her credit card, and she came back to me when she was ready to go forward. We ran credit, and it dropped to a 690. And for her, that was a major difference in the interest rate, because they were trying to do certain things. And that's all because she canceled a credit card. So as I'm telling people, do not do what that person out there tells you to do by canceling all your credit cards. Their big push says, well, you can do a manual underwrite, but you don't want to. That limits what you are available to do out there with a manual underwrite. And there's only so many companies out there who do manual underwrites anymore. Yes, we can get it done, but why do we want to go through that headache? Why do you want to go through that headache? Just learn how to pay down your credit cards, learn how to utilize them, and move forward. It's like anything. You have to learn how to use it, right?
Yeah. Well, perfect, Ed. Well, I think we pretty much covered that one. I know for anyone who's watching us, we're going to continue doing this series. So we're doing Home Buying 101. We're going to go, I think, Home Buying 101.4. We're going to be doing that. And I close.
Are we doing Thursday?
Yeah, we're going to do that on Thursday.
And because it's home loans 101.3 today, so it'd be home loans 101.4, And what is it? What are we talking about on Thursday? Do you know?
I believe we're going to be talking about how much cash you need to close.
Okay, so we'll talk down payments and different things. All right.
Yeah, and then also how long you have to be in a home. Like, say you purchase a home with the FHA loan, how long you have to be in it before it could be an investment property or a rental. You can turn it into a rental. So,
right. Well, we'll explain that because it's about intent. So let's not get into it now because it will go another 15, 20 minutes.
yeah, there's just some of the things coming up. If anyone has any questions they might want us to cover, please let us know in the comments below.
Right. And they can also reach out through us through Facebook, direct message us, or even on Instagram. All right. Thank you, Bobby. Thanks for
so
asking
much, Ed.
questions. All right. Have a great day.
Thanks, you too.
All right. Well.